Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Week update here for June 16th, 2022. We are in the midst of a wildly volatile market here over the last several weeks, and it's only seeming to be picking up pace here. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. With all that being said, we'll probably be focusing today a little bit more on spread markets. The outright futures, well, we did actually get some moves today that I've been a little bit, more impressed with. We'll talk about those here in just a minute. But let's begin today talking about exports. Weather is going to be what it is. Obviously, we got this heat dome and this high dry heat coming through the Midwest over this next week. Certainly a little too early in the year for that type of weather market. Probably a good reason why corn has been so better bid than the beans. Obviously, corn not being able to take that heat early, where beans can be stressed a little early on and still make for a good crop later as they fill out pods late in the year. But that stress that we're seeing on corn now, from a lot of guys that I've talked to, we're still, a couple weeks to maybe a month out really until we start to see pollination begin and we get into the tassel, which of course is going to be really bad if we remain this hot and dry through then. But this is, a time where we're stressing the crop, where, we're shooting down roots and developing, the early stages of the crop. So, things are recoverable. But again, we get too hot and dry, you get burnt out this early. The crop is obviously going to go into more of survival mode than anything else. And on a year where we really need record yields to keep that trend line going, it's going to be really hard to, I think, to achieve. We've already short acres across the country, and that's, of course, I think another reason corn is been better bid here in the near term. But the weather situation, right, is more of a corn market right now than the beans. Wheat has had max, harvest pressure kind of going into mid-June and into July here, but we're starting to see a little bit of a relief rally there, and we'll, let's kick it off with the wheat, and then, we'll segue into corn via the corn wheat ratio here in just a minute. Okay, so we have that next in the series short from the $11 figure basically still holding. This has been very choppy, sideways and corrective for wheat. If we push above $11 and certainly above 11.20, I think that will constitute a technical break of this downward trend that we've had off the highs. Double top up there around 1284, and if we get going above 1120, certainly could see another move back to that contract high, and above would open the door for much higher prices. That larger full 50% swing from the 730 lows through the 1279 highs here has held down into that $10 mark. We still have an open gap that has been left open here at 1014. I would have actually preferred to see the market sell off down to that level, bounce, and then go up and take out $11 and what have you. But say la vie, that's just the nature of gaps. Sometimes we leave them open, and the longer it's left open, the more bullish this chart kind of is at this time. And we seem to be defending against getting there from today's price action. The last several weeks price action, I should say. But for all intents and purposes, we're still very much in a range here between $10.40 and $11. But I would like to see, wheat get above this little bit of a trend line we've got going against the highs, where resistance came in today. If we can push through that here in the overnight, clear the $11 handle and make new highs for the month, potentially a reason to be a buyer in the dip. Because we've really run out of reasons to be bearish wheat at this point in time, knowing that production is what it is, and we're just going back out to, what the global export market might be looking for here for U.S. and Chicago wheat. Over the last couple of weeks, I've been liking the idea of this. And I've got up here the Kansas City Chicago wheat spread. Pulling back a little bit here, I was looking for it to stay above 70. Okay, it slipped below 70 here. Still basically a 50 back from the lows around 20 cents over to the highs of $1.08 over. So for all intents and purposes, still making progress. 2 steps forward, 1 step back right now in a 1, 2, 3, 4, 5, 6, and 7 swings lower, 3, 7, and 11 are corrective wave structures and Elliott waves. So, okay, made a new low there. If we find a low here and certainly stay above 60 cents over, I would, expect this market to maybe pick itself back up and start building in that protein premium, into that KC contract relative to the Chicago. I'm not saying we'll go above $1.10 or $1.20 over, but a 60-cent swing from the low end of this chart range that we've been in for the last couple months back up to that level is probably still anticipated. Trendline support here, if drawn from the 320 lows through the May 4th low, comes in right around here, this low at 65 cents over that we've traded down into. So, okay, maybe that was all we needed, that one more push lower. So long as we get some capitulation here and a snapback above, back above 70 and towards 80 cents over, I will be anticipating, KC coming back to, well, it's at a premium of 65 cents to the Chicago contract, but I think that could widen out, towards $1. As it's kind of been anticipated here over the last couple, I've been anticipating more it holding, I should say, and bull spreading higher. Okay, Chicago wheat relative to corn here. Actually looks very similar to our KC Chicago spread, right? With kind of 2 steps forward, 1 step back at this time, into 50% retracement from its contract low here at $1.76 over, up to the 525 over, or 524 and quarter cents over highs. You have a trend line against the lows here that comes in as support around 350. You had this old trend line resistance against the highs that we came back, tested once, came back down to test again as support. So where those two trend lines meet here kind of formed an apex. And now we're holding, I would look at this trend line against the highs right now as a good reason for the market to potentially take a move higher here out of this range that we've been in. But I am looking now for that the wheat corn spread to possibly find a bottom. Given the outside day that we had today on the chart, I think a push above 380 over could take this thing. And then I'm looking at the December contracts here, by the way, December wheat to Chicago. Don't know why it's not wanting to give me it as a spread here. But either way, we're still looking, generally speaking, this is still the right chart here. But looking for this to widen out again, go back up, towards $5 over potentially in a seasonally bullish time of the year for this spread. And again, this helps support the idea of maybe a reversal in the wheat complex. And let's face it, wheat easily, I think, could rally $5 from where we're at to $15, right? But rallying from $7 or $8 in corn to $7.80, $7.35, depending on if you're looking at which contract you're looking at. But rallying $5 in the corn to $12 is a little bit harder of a pill to swallow. I think maybe we've got a $2.50 kind of upside cap on how much corn can move, whereas wheat could easily take out its highs and head to all-time highs and certainly above the recent highs we've seen, which could widen the spread out considerably. So watching that here, and this reversal that we've seen intraday, if we can push above 380 over, certainly getting up into overbought territory, but coming off of a low like this 4-hour RSI, I would constitute as kind of a bullish signal at this time. So maybe that swing and that reversal is happening and starting to happen, something to keep an eye out there in the near term. So that brings us into corn. Very strong corn markets. In fact, over the last couple of weeks, I've been pretty darn impressed by December corn, how well it's been behaving. July corn as well, both of those markets taking out 61.8 lines we'll look at here in a minute. But let's start the day with the daily chart of July corn here. and finally pushed above that 55-day moving average at 774. 18-day moving average were above that as well at 762. Haven't even touched or come anywhere near the 100 and 200-day moving average, and now starting to break above this trendline resistance against the highs. So for all intents and purposes, July corn is now breaking out of just about every technical indicator you can throw at it here. We have hit overbought here on the daily RSI, but markets can remain overbought longer than shorts can remain liquid here. And certainly in the weather markets that we're experiencing now for December or for corn, I think there's a reason we see them December and July here moving at parity. In other words, they're moving tick for tick with each other in today's price action. And arguably, we might be a little bit more December driven, but of course, in an inverted market like this, we're going to see that demand for that near-term contract anyway, as the market is generally trying to, or market buyers and commercial buyers are just trying to get their hands on whatever corn they can in fear that, hey, in a weather market, we're not going to have any or be short on production this year when new crop rolls around, right? Okay, so pretty good look to the daily chart. I would not be surprised to see pullbacks here, but support is probably going to be found around 760, and we might head a little bit higher to test $8 before then. December corn, very similar levels, just ratchet them down a little bit. 18-day moving average at 716. We've established ourselves above that. Finally broke above that 55-day moving average at 725 here today. 100 days down around 675, and the 200-day all the way down there at $6. Probably a really big support if we ever got down there, but that's a whole nother ball story. And I don't really know if this market has what it takes to find any kind of top at this point, but that all remains to be seen. Certainly if weather markets continue to prevail here, but again, overbought here on the daily RSI, but given the breakout situation we've seen, it's still, I think, a buy the dip mentality here for corn. All right, July corn, full 50% retracements off the high from 824 down to lows here. Like I said, we broke above 61.8 lines now. So that was the big 50% short that I talked about last week. It was fearful. It was getting reaction. Okay, could that be the reason that we sell off down below $7? It could have been. But weather markets, and for whatever reason, the market gods have dictated that corn needs to stay up at the prices that we're seeing. Trendline support against the lows here come in around 775. We've need to draw up the full 50% retracement from 720 now up to 792. That comes around 756. If it were to go back down there, it's an interesting area I might be interested in buying. And of course, we need to draw up trend lines against the lows in general here. In some capacity, there is there's a trend line here, and I'll probably drag it over to this. Drag this over to this low here from mid-February. But the 50% from that swing, that's 641 up to 824, 734, that supportive area that has held in the charts, also aligning with this old resistance zone, now is support on the chart. And so that kind of confluence area between 740 and 720 is the area we came back down and tested. Now we've bounced. Upside swings could take us towards 867 and onwards towards 936 if we extend beyond that from that swing. Now there's going to be pulls and such inside here that we'll need to watch. And of course, this last swing higher, the most aggressive pull that I would put up on this chart right now is from that 760 area up towards 792, 775. So you've got trendline support around 775. You got this small 50 back and this these old highs that we've kind of broken out of, which would be broken trendline resistance. Now is support on the way back down. So watching the 775 to 770 is your first support for corn, and below that, the 755 to 750 area. Be interested in being a buyer now on this chart as we seem to be trending higher for July corn. December corn, very similar price action. In fact, talk everything I said, just move it to December prices, and it's pretty much the exact same deal at this point. Full 50% short off the highs has broken, or from the contract high down to that 682 low. Here we actually were holding both sides, I would say, of the coin for corn. December corn had a bit of a deeper pullback there to 705 to test just about that 705 figure, and it's already traded to its target. So from that low to the highs after, um, from that low to the highs after here, I would put in the next 50% swing here at 724. So from 707 lows to the 741 highs, that 724 and a half area, 725. Also, again, the other, this confluence of highs and resistance that we've seen that we've now broken through. Pull back to 725 would be my first area of interest for December corn. And then below that, down around 711 to 704 would be my next area of interest. But look out. Trendline support again here, aligning with that 725 area. If we get a pullback, it's the old highs. It's a 50% in the next in series swing, and could be a reason December corn continues leading the way higher here in the near term. Okay, so soybeans have been a little bit trickier as of late. Pulling up actually, did I talk about, before we go into soybeans, let's actually take a quick look at that July DEES spread here. Holding that 30 cents over, that is definitely the line in the sand to consider continuing to bull spread here for December corn. Interesting that we have not broken above this 60 cents over high. We seem to be flagging still between, well, now it's, of course, 30 cents over has been supportive to the downside, but now failure to break out of 60 cents over is something to consider. And of course, kind of just sitting here going sideways in the calendar spread is a good reason why we've been able to watch both, old and new crop corn contracts, the outright futures, right, move in lockstep as of late. But if the July contracts begins to take over, I would expect, obviously, this market to push above 60 cents over and head back towards $1 over, which would make sense, at this time for this market, considering it is, of course. An inverted market. We have tight carryouts and every reason to continue to look for that. But at this point, I would say that a breakout above 60 cents over might be the buy on here for a move towards $1 to $1.20, what have you. Because while we're below that level, we could still be just flagging in a range, and nothing says we have to. Particularly if the market just deems a reason to build that premium into December at this time. But again, still bullish here on this while we're above 30 cents over. Maybe the breakout of 60 cents over is where you start to bull spread from, or how you make a decision between December and July. But as it stands, the reason we're going sideways in this range is because the market has just been unable to determine where it wants to build that and put that premium this year, even though it really should, July should still be a driving factor. Anyway, all right, so July beans here, 18-day moving average is still resistance on this chart. It was pretty much resistance here into today at 1712. A very different look to the chart than corn. We kind of had a breakout here, and maybe a little bit of a blow off top here up towards the contract highs at 1784, falling $1 off that high down to the 1683 lows. Not the end of the world. That was a 50% pullback from this swing from 1580 up to that area. So interesting that we held that 50% line, and we'll look at that in a minute. 55-day moving average down around 1670 could still definitely get a test. 100-day down around 1640, and 200-day way down there 1472. Shouldn't even consider that price yet. But a move back down in this range towards $16 would be pretty nasty, but not out of the question either, because we're still back below the high end of the range. We're back into the range that we were in, and unless beans take over here with velocity back towards $18, and certainly get back above, the 1730 area, I am very still worried about this chart. Novi beans, similar idea, but actually trying to put a little bit more pressure on their market, or put pressure on the high end. They actually did manage to break above that 18-day moving average. So we've been seeing some bear spreading here in the beans, where we're not in the corn. We were oversold in the Novi bean. We're still oversold, but starting to come out and unwind that condition here for that daily RSI. But Novi beans here above that 18-day moving average here into the close today at 1537. That was a good look. And November beans leading the way here today, up 19 3/4 compared to the 15 cents there for the July contract. Okay, so again, I might as well segue right into the old crop, new crop spread here for November beans. Still, I was hoping they would start this channel higher. We came back down to test the channel. We broke below it. Now we're holding it kind of as resistance. That old trend line, not a good look in the near term. Full 50% inside that range did not hold. So really, we're just right back down to the old 50% from $1.30 over to $2 over. Testing that old support here around $1.60 over. No way to cut this other than a 70-cent range on the spread. At least we're ranging, on the upper, 20 or upper 50% of that range. But still, day after day of bear spreading here, with today being no different. We were green, we were bear spreading a green day for soybeans. Not a good look. Very different than, our corn market that was bull spreading a green day. That makes sense, right? Even it was barely bull spread, but still, it was bull spreading. This is bear spreading on a green day, on a green day here for the beans, which leads me to believe that there is something still to be worried about in the short term. And certainly an inside day on this spread, while below 173 over and above 162 over, that 10-cent range here gives me concern. If we start to break down, could unwind down to $1.20 over, and certainly, unwind and build more carry into the market. And maybe that's what beans are needing to do in the near term while we kind of navigate these waters going forward. Okay, on the intraday chart here, I've got the hourly chart up. I'm going to go out to the 4-hour chart. I had mentioned before that 1580 swing up to the 1784 highs, that full 50% retracement here at 1682, traded basically to the tick. We are unfortunately trading back into this broken trendline support that we had against the lows. It was holding there on that initial drop, that 3-day drop down into $17. We broke below it. Now we're holding it as resistance on the way back up. Not a great short-term look for soybeans. However, when we dial down to the smaller time frame, you can see there is some hope. Full 50% short off the highs if it gets up there is around 1730. At this point in time, though, maybe a same anchor new low on soybeans as well. So while we're below 1721, 1720, I am a little cautious about the soybean market at this time, and that there may be another leg lower. And if that leg lower really accelerates, there is not much once you get below 1680 again. There is not much again until you get down to 1580 or 1600, 1580s. So yeah, being very, very cautious here with my soybean analysis, because the chart is not that bullish, and a 2-day bounce or a day and a half bounce after a dollar decline, a 20-30 cent bounce after a dollar decline does not a reversal in the trend make, but it is certainly promising. Let's go down to the 15-minute chart here, because there was a little bit of a pullback here this morning to test the 618 line, the swing from 1682 high or low to the highs of the day at 1713. We came down, tested that 618 line at 1694. Upside targets could take us towards 1720. So okay, the ball is in the Bears' court or Bulls' court, excuse me, in the short term, and certainly on the smaller time frame now. But soybeans really need to prove it to us and just get going here and pretty much never look back. Because threatening the 1682 low again, there is not much in the way below that threshold, back down in this range towards 1580, which, okay, maybe we need to unwind here into the July contract. Maybe we will be doing that, into end of life for July, and then we find an early an August low, an early harvest low like we did last year, before this market takes off again. We shall see. But I guess lows didn't really come into the July chart last year until November timeframe anyway. But let's go out to the daily chart, because if I remember correctly, really, it's not going to go. Oh, because it's an hourly chart. There we go. That's the chart I wanted. Yeah, here you go. So we peaked out around July. We sold off down through, basically into October, November, where then we found those lows. So, fully prepared for a June, July that could look, something like this, and then that kind of meandering lower price action into and through harvest, could easily happen here, and July beans is a bad example. So let's look at November. It's a good segue into the November contract now. Let's go out to that. Okay, so again, last year November contract actually made its low in July, and then never made it as low. But that meandering sideways to down here and staying above 12, looking at November of next year, I would imagine that, we'll probably, well, no, let's just stick with this, but that would probably only allow this contract down to, 1475 to 1450 over the next couple months. So, this is sideways at highs that eventually broke out. There's nothing that says we couldn't, go into a similar type structure. But then again, if we continue with this hot and dry, forecast, and we trade into August without much of a sell-off, and continue with the status quo, I can make a good case for why this market still has much higher to go. All right, so old resistance here into this 55 to 1540 area is the level that we came back down into. Unlike July beans, November beans have basically pulled back twice now into 50% levels, giving us potential upside. Unfortunately, there was one that pulled back into $15 and kind of went to target here. Next in the series didn't hold, but the full 50% pullback here into 1520 from basically 1438 low to the highs after is traded to. My concern with November beans right now is that they've already traded up into the full 50% short off the highs into 1550. So if they roll over for another test of $15, that would put pressure on this trend line higher, and we'd have to be thinking about 1488, a full 50% long here. But truthfully, at that point, trend lines are breaking, and there's not much that would keep us from staying or not getting back down to 1450, below 1450 and towards $14 at that time. So something to consider and think about. That beans have every ability to prove themselves to us and rally here, certainly if they're going to follow the corn. But another leg lower for the beans still cannot be ruled out. And, I am a little cautious and worried that that might happen. But nevertheless, it's the ball's in the Bulls' court after today's close. We'll see how well they can trade it and take it from here. Okay, crude oil. Let's get into the crude a little bit here. The full 50% retracement from our swing from 93 lows to the $1.23 highs here, was down around 108. We didn't quite get there. Today's sharp $5 reversal from the lows to finish higher on the day definitely feels like a capitulating low, a retest of our old levels, and really, a break, maybe a breakdown to test, trendline resistance here again as support on its way down. But I wouldn't be surprised to see another leg lower to test 107 to 105 before rallying, but it doesn't need to happen. You make a case for us holding, trendline support here, still channeling higher, all those good reasons, 2 steps forward, 1 step back. It's 2 steps forward, 1 step back, 2 steps forward, 1 step back, and potentially trading into 618 line of this last leg higher. So the 103 low to the 123 highs, the 110 figure was actually the 618 line. So it bounced off that. We're back above the 50 and reversing the day. So a swing up towards 127 now for crude can't be ruled out. And if we're going to 127, why wouldn't we be, in this larger 96 pull? That could take us all the way up to 146. So I hate to be the one to say it, but that might be a low for crude oil prices here for the next week or several weeks before we rally up into a top here into July, which seasonally is when we top out around 4th of July in crude prices anyway. So let's just get it over with, get up there so the market can reverse, put in a high, another maybe all-time high or a new contract high, certainly. Reverse, and we can, start seeing prices maybe unwind a little bit from the pump. But unfortunately, I think crude's got higher to go here in the near term, which should be supportive for our corn and biofuels. But yeah, something to consider. S&P, holy cow. This thing is dropping like a rock the last few days. The next in the series, 50% short, held. Didn't really think, I thought we'd get a test of 4220 there. But that swing from entry highs around 4,200 down to its 3,600 lows is just about nearing completion. That doesn't mean it can't continue lower, but something to consider here for the S&P, which is ultimately channeling lower at this time from all-time highs. Definitely does not look like the start of an impulse lower. This are all very choppy, overlapping waves, but this is one swing down, 2, 3, 4, 5. There's probably still a 6 and a 7 to go before this is complete. So we were cautiously optimistic there that a 3,800 low might be forming, and I guess the market just needed to go a little bit lower. We got an open gap on the chart now, right up here around 3,900. So look for that level eventually for us to get back up to fill, and certainly we'll probably fill that one on the way back up when this market is finally done. Taking a big step out on the daily time frame, however. From our recession or pandemic recession low to the high after, 3,500, 3,494 is a full 50% retracement. So seem to be eyeing the pullback, retest of old all-time highs there at 3,400. I mean, just seems like the most logical place for us to go. But if I was to guess on how we get there, we're going to probably bounce somewhere soon here. Next in the series now, swing from the 4,200 high down to the lows after at 3,600. Look for basically a move back towards 3,900 as resistance, fill that gap, and then another swing lower that would take you down to 3,500 at that time. But anyone's guess at this time. But this risk off, this macroeconomic issue we have of risk off, I think we're getting closer and closer to a bottom, but it's just not, this market's not done going down yet. And so that's something we need to be very aware of, and could certainly continue to roll, spill over into our ag products. All right, cattle prices real quick. The August live cattle, man, oh man, talk about a range that we've been in. Full 50% longs off the lows fail to hold. The 50% short from contract highs to lows after has failed to hold. And so now what we have is a 61.8 line, 61.8 line trade. So whenever I see two 61.8 lines of subsequent polls trade after each other, I immediately start drawing up resistance trend lines, supportive trend line, these don't mean anything yet, but they're just to remind me that I'm looking for a range to trade out here. So between 130 and this $10 range between 130 and 140 is probably going to see some more chop in the near term. And certainly, I think cattle are going to have a really hard time. The live cattle are going to have a hard time rallying while we're still so bearish in the equity indices, and there's still that risk-off mentality. I think they haven't sold off and really reversed the strength that we've seen over the last couple months, mainly because there's just no reason in this inflationary environment to see massive sell-off in food prices. But it is, I am struggling to find a reason to be bullish at this time, which is why I think we're going to see more sideways price action. But just wanted to point that out, that on intraday here, it looks like we're going to continue in some kind of range there for the fats and the feeders. Feeder cattle, false breakout of this trend line resistance, full 50% retracement from the 187 highs, the 162 lows. Okay, trades up there, starting to roll over here. Kind of a head and shoulders pattern. Look to it with a neckline right around 170 or something. So, yeah, feeder cattle might be, and feeders being the leaders, might be the canary in the coal mine here, for a reason we could head a little lower. Full 50% retracement from that 176.87 high down to the 169 low has held and kind of rolling over and putting pressure on the full 50% swing from 162 lows to highs that traded around 169.83. So kind of both sides of the market getting reactions. I mean, very different than what we saw on the fats, isn't it? The fats, neither one of those levels held, but it constitutes range-bound price action. In the feeders, we had both a long and a short hold here. So it's a fight over the trend, between this 176 area and the 170, 168 area. That $10 handle is a swing, a range, I should say, is probably going to see the market bounce around until one side, prevails. And at this time, if the shorts prevail, we go down to 168 and fall apart, well, we'll have a good reason. And a reason to continue to watch this. But yeah, both the cattle charts showing, giving us signals for maybe more sideways price action than rather than trending markets, but for very different reasons. And I thought that was kind of interesting and wanted to point that out here today. All right. Is there anything else I want to go over and talk about at this time? Not really. One last thing. Pretty bad export numbers today, marketing year lows, what have you, but the accumulated net U.S. corn export sales for next marketing year is this big black line, and look at how ahead of the curve we are, only to have been beaten by last year at this point. And we all know what prices have done since then. So special thanks to Karen Braun from Reuters here for putting together these great charts that we follow on Twitter. You can see her handle here at KANNBWX. On Twitter. But yeah, ahead of the curve here. And while we've been, kind of slowing pace on those export numbers, they have, we are well ahead of the pace here. And probably a good reason why corn is still, remain better bid relative to the soybeans as of late is because we are just so far ahead on exports already that we have some room to slow down here at a time of the year when we would expect a little bit of a slowdown. But the fact that we're even seeing exports happen and sales still continue to happen, I think, and at the prices that we have, is a good, good signal for how, high demand U.S. production is in the face of, being short crops in the Ukraine and in South America as well. So, with all that being said, everybody, thanks for joining me here today for our Strategy of the Week webinar. I can always be reached over here at Zaner at 312-277-0110. You can find me on Twitter, shoot me an email on Facebook, or shoot me a message on Facebook there, or find my email here on the screen and shoot me a comment. Again, anyone who attends these webinars or if you want to see something in particularly covered, you got questions, shoot me an email ahead of time. I'll be happy to answer those questions and get answers for you, or cover any kind of material and anything that you guys want to see more of in the Strategy of the Week webinar. No real trades here today. I think that I need to see some proof from our row crops before I feel more confident in getting back into reownership at this time. I mean, corn I think has no reason to have bailed on reownership, but the beans here I am still cautiously optimistic about. We'll see how they trade out here into next week. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.